Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there and see what's going on. You can follow me at finding_finance, and you can join our community at finding-value.com. That is where I dive deeper into individual companies, stocks, sectors, and I do a lot of training sessions for people who take on the strategy to try to do 5 baggers, 10 baggers, 20 baggers, 30 baggers over periods of time. It's basically identifying where the value is in the market. So let's go into this. We've got Rodrigo. He says it makes total sense to buy copper and oil only when the recession is behind us. But if global growth has been lower than inflation for years, doesn't that change the perfect entry point? And a lot of people are saying that they are going to wait after the recession and they're going to buy copper and oil, but only after then. What I'll say there is there's three pillars to this that I look at. The three pillars are ratios, market conditions, and technical analysis. One or two of these things can be good, and one or two could be in disagreement. You don't have full alignment. Or maybe you're later in the cycle, the yield curve's inverted like we've got, and that is part of the market conditions, and you don't have full alignment where you could get a higher move in copper or oil. But here's the thing. Technical analysis will also help you figure out where you're at in the market conditions. Why do we have a breakout of copper and oil to the upside along with gold and silver? Maybe it is something that you are missing. Maybe it's no recession, or maybe we have stagflation where it's a recession and we have lots of inflation. So what I do is I buy companies or sectors that are undervalued, and then I hold them until they become overvalued. What you're trying to do here is you're trying to basically time the market to the best of your ability, saying that there is a recession that's in the bag. What if the recession is already behind us and we have, or a slowdown is already behind us and we've got some growth for the next 3, 4, 5 years before a bigger, larger correction in the market occurs in terms of the sectors that we're interested in, copper and oil for your specific example. What if there's a war that is coming, World War III, where these go up tremendously and they go up, oil goes to $200 a barrel, and then we get a recession shortly after that. I don't think a lot of these people who just say this stuff, I don't know if they're that connected to the market. And I don't know if they've got the experience because it's like people just make these claims that it's so easy. I've had other people on the channel before where they say, well, recession's definitely coming. It's coming next year. It's like, really? You know that a recession's coming next year. You know that the yield curve is just going to drop. You know that the U.S. banking system has all these great loans on the books and that it won't necessarily reverse. What I'm telling you is I don't know. I don't have the answers in the future. I don't make these predictions. What I do is I go off of the data that I have in the market. Oil is breaking to the upside. I'm not going to sell it. Sorry. It's not putting in a topping pattern. Sorry. And if I get caught in a sell-off where the market does go down, and let's say oil goes to $60 or $70 a barrel from where we're at today, then I'm going to ride through it. And I'm going to not try to make a prediction. So you guys could be left out, and then you'll FOMO in later, perhaps, or perhaps not. Maybe you just missed the whole entire train that's leaving. But I go off of the signals that I've got. Technical analysis is telling me that the signal is a go for oil and silver and some of these other ones. I also don't put all my money in one sector or the other. I spread it across, and some of them are uncorrelated. If the symmetries are large enough, to the upside versus the downside, then it's going to carry the portfolio higher, even if, let's say, oil doesn't go anywhere or it's slow. Then my silver stocks will rip it. I'll make multiple hundreds of percents in silver stocks while my oil kind of just goes sideways. I had a lot of stocks in 2022 in the oil and energy service sectors that went up over 100%, even though oil went down a little bit. Pretty interesting, I know. Coming on down, we got it says it doesn't happen often. Bitcoin closed 2 consecutive months over the upper Bollinger Band. Each time it has then doubled within 3 months before the next red candle. And what I wanted to talk about here, I don't believe in what he says here. I'm just going to give you my opinion as we go. This is the chart that is uh, blown up here. Here's an observation that I see, and usually this deals with something that is slowing down. If you look at the beginning here, you can see all the big green candlesticks, the big up candlesticks. Boom, 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 small pullback. Boom, 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 small pullback. Boom, 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 small pullback. And then when you get up here, what you can see is that the large up candlesticks are getting smaller over here. Then you can also look at the potential pullbacks too. This was a kind of a big pullback through here, a couple big candlesticks. Now, I'm not convinced that this is just going to rip higher. It very well could. What I would be looking for is look for large red candlesticks or down candlesticks, much like this one here, where you could get a potential pullback. We're not there yet, and this very well could go higher before that occurs. But a lot of people, I think, just assume that if a trend that is in motion will always stay in motion and go up and up and up forever. This is highly linked. The Bitcoin is highly linked to the NASDAQ. And the NASDAQ looks like it could potentially be topping. That's where I'm getting my potential top confluence from. It's from the NASDAQ. Now, I don't know if this is going to top here or not. And I'm not making a topping call. What I'm saying is look for evidence that it could potentially top, because I know that the NASDAQ and Bitcoin have been correlated in the past. And I'm trying to see if that correlation remains intact. Coming down, we've got nat gas demand now sharply skewed to power burn versus a decade ago. So this is power burn. We're at 40% power burn in 2023. I think it even jumped higher than that for 2020. No, 2023. It's 40. It's a little over 40% is what I've read. So 40% here, others 10, industrial 26, residential commercial. So this is the demand split for this in terms of natural gas. So 10% other, residential commercial, probably heating, stuff like that, industrial, and then power burn. And here's power burn back in the demand for natural gas was 31%. So it jumped quite a bit over this 10-year period for power burn. Power burn is for electricity. I mean, just to let you guys know. Power burn increasingly important. You can see that we gapped up even from 2023, which is down here. That's maybe 32. Now we're up around 37 billion cubic feet per day, and that's for electrical generation power burn gas demand. So we're even smoking to the upside in 2024 for January versus previous years of power burn. And you can see that we are up towards the upper end of that, basically that band. The 5-year average is the red. In 2023, it was up there, and we're off the charts right now in terms of that band that we're using around the 5-year average. So we are definitely increasing natural gas power burn for electricity generation. Here's a really interesting chart. I've watched this one too, and I've charted this on TradingView, and this is the United States inflation rate. It says inflation a problem, question mark, not as long as we stay within the wedge, where it can conceivably remain for another 20 years. I don't think it's going to stay in the wedge. That's my opinion. What this is it goes all the way back to 1913 when the Federal Reserve went into power, basically. We've been going down into a consolidated range, and I think this is going to break to the upside and have a monster move to the upside. Why do I think that? because credit's going to be created faster than what energy can supply. And energy is more or less your GDP. So if credit outspan, if credit is created at a faster rate than what your GDP can grow, that is inflation. And this is going to break out. We probably already broke out. We're probably up here already. And this is just manipulated numbers, but we're probably already broken out. And if we've broken out, this will be a big monster breakout move. The size of the move is generally the size of the pattern entry. So if the pattern entry is this big, we're probably going to go way up here to like 20 something percent, 20 something percent inflation rates. So we're probably going to, the size of the entries is this, and that's going to be projected on top, and we'll go up to like 25, 30% inflation rate. It'll obviously be doctored lower to some degree, but that's where we're going to probably go. The driver will be oil. It could be a war. It could be a very high inflation period where we can't afford our debts, interest payments, all that stuff. Combination of all those things that are going to push us to that level. Skipping over that, investing is 5% intellect and 95% temperament. It's a test of how well you can sit quietly when your emotions are screaming at you to do the wrong thing. Totally agree with that. And the majority of people, I've got multiple companies over 10 times my money since the bottom of 2020 that I'm still writing today. And it's tough. And I kind of just flipped it in my head because I said, you know what? I know what I did last bull market. Not going to do that again. And I just refuse. I'm like stubborn to try to sell out and try to time the market. And I don't think a lot of people can do that. I really don't. I think it's really tough. But that's where all the money's made. That's where all the money's made. It's 5% intellect, 95% temperament. Here's a chart on residential construction hiring. More to do with that recessionary first post that I was talking about. Slow down, no more, reaccelerating. And this is where the people get it wrong, potentially. Could the tech stocks pull back and some not foreclosures, I should say, some bankruptcies disrupt the market? It's possible. But the main driver of the economy, which generally drives into a recession, is not the stock market. It is residential construction hiring. This is a big driver of how well the economy does. And this is employees on non-farm payrolls, residential construction. The residential construction market is one of the largest. It's also a big factor in creating credit in the system. So you've got fiscal side and then you've got the monetary side. The monetary side is this bank lending residential construction boom. The other side is the fiscal spending and the government and all that stuff over there. We've got high fiscal spending. We also have the monetary side. It's somewhat controlled. It's not pumping it yet, not like 2020. The affordability and the increasing of interest rates has slowed down home sales, and I'm sure it's slowed down lending as well to some degree. It doesn't mean it stopped it. I'm just saying it slowed it down to some extent. It slowed the monetary credit expansion growth. The problem is, and the problem that Powell is in, is when he goes to slow this down, which has the largest demographic cohort coming through home buying years, is he's trying to slow it down with that coming through, which requires high interest rates, and to basically jam that affordability way up where people can't afford to make transactions. But as the interest rates go up, it impacts the interest expense on the debt for the fiscal side, which then you get inflation from that because they're going to have to print money to cover the interest expense. And then they got to roll over all this other debt, and it's just one big money printing fest on the fiscal side. So you're going to get inflation whether you increase interest rates or whether you decrease interest rates, either from fiscal side or from the monetary side. And that's where I think the people are getting it wrong, is they're like, we're going to wait for a crash in the recession. And it's like, well, what if you crash upwards? What if you slow down, but the market continues to go up because of all the money that needs to be created on the fiscal side? And then if he tries to lower it, you get monetary inflation. And there might be a little slowdown between that move of interest rates. It's possible, but that's kind of we're just not seeing that slowdown here. That's what I'm saying. Money managers boosted bullish bets on gasoline to levels not seen in 3 years, helping push New York futures to a 7-month high. Hedge funds raised net long gasoline positions to that in the week ended of April 2nd. So this is we're up at a really high contract here. Now, I don't get bullish when things are high. I get bullish when they're low. And then I would ride this up and sell basically where we're at today. So, but the bulls are piling into gasoline. Wagers on gasoline futures jumped to a 3-year high. Maybe they're right, maybe they're wrong. But I usually take the low end and go long on the low end. I'm coming down to Ronnie. He says, I just love this quote: be right when everyone else is wrong at scale. That's pretty much how you make a lot of money. And what he means by everyone else, the majority of people, they think in herds. Somebody says something, and then everyone else just parrots what they say. So if I were to say, platinum's really cheap, everyone else is going to run, platinum's cheap, oh, yeah, platinum's cheap, and it is cheap. I will say that. And then people, what they're going to do is if it stays cheap for a year or two, they're going to be like, well, how come it's not going up? Why is it not going up? It's like, well, something can be cheap for a while, and you get rich by buying 7 different assets that are not necessarily 100% correlated, and then they move at different times under different market conditions. So, so that's what keeps your portfolio moving forward is things are not 100% correlated. They continue to go up at different times. And sometimes they stair step, like one will go up like this, go sideways, and then go up, sideways, pull back a little bit, and then go back up. Things like that occur. So I think what a lot of people do is they try to pile into one sector, buying one asset, and then they just hope that it goes up. But then you're trying to time the market. Timing the market can be hard. So that's why I take 4, 5, 6, 7 different sectors or more, and then I buy the best companies in those sectors. Maybe it's 1 or 2 or 3 in each sector, and then I buy them at really good entry points using technical analysis when the ratios are low, and it'll work out if I sit and don't sell them until they're overvalued, which can take a decade plus. And maybe they all move together at some point when the dollar drops or something like that. That'll be okay. And sometimes they do get correlated in the short term where everything can drop for a short period of time. And it does create some wicked volatility. Tony Greer says copper, we've been working the length out of the market and disinteresting and frustrating people for 2 years. This thing is going to go. It says the move out of it is a function of how long and the level of max frustration it took to put things to sleep in the first place. Yeah, I agree. It says you might think you want a fancy car or a nice watch, but what you probably want is respect and admiration. That's probably what I think that's what most people want. They're trying to show off. They want respect. I agree, and they want people to envy them. And they try to do that by buying crap, more or less. I think that's also a driver of some people. Like they're trying to measure their status in a society or where they rank in the hierarchy potentially. That could also be something that they're trying to do, and this is a way of showing that rank to other people. If gold and silver ratios breaks down multi-year support next week, we could witness parabolic price action in silver. This should hopefully create FOMO effect in the precious metals miners. We very well could do that. Now, see, I don't try to make these predictions, and I don't think he's really predicting here, but those are possibilities. And I don't base my investment decisions off of solely possibilities. What I do is I basically look at the probability and then I ask, well, how much upside does this thing really have? And then you want to multiply the two together. What's the probability times the outsized return? And this is more of an art form of picking companies than it is a mathematical equation. Obviously I said that, but you don't know exactly with any precision what the upside really is. And there's a bunch of biases that people have in making those decisions. So a lot of people will say, well, uranium junior miners, they're just going to go parabolic. And it's like, well, the uranium junior miners may or may not outperform a company with a lot less risk with a higher probability of success of following a sector. That isn't 100% given. And when I hear people talk about things, they just say, "Oh yeah, well I'm going to get into juniors because they're going to perform better." It's like I don't think you've put any thought into it. Where some of these companies are so out of favor, potentially like a sector during certain times in the market, where you can buy a producer, a high cost producer, at 99% below its all time high. And what if it goes up 3 or 4 times greater than its all time high? So you buy it at like pennies on the dollar, and then you get 100 bagger to the upside plus. And that most likely will beat the majority of uranium junior companies. That's probably the case. And I do think that I purchased a few potential 100 baggers in oil at the bottom of the 2020 market. They are producers. So obviously they're growing production, they're producing and growing, but uh, I see that as one of the highest probability bets that I have taken in my life, and that's why I chose specific companies like that. A lot of people would not have thought that oil companies could do that. And I think the biases are preventing people from taking very good entry points in sectors that might inherently be lower risk versus higher risk companies in a sector that may or may not pan out the way that they thought it was going to pan out. Now, I'm not picking on uranium companies or the sector; they very well could pan out. I'm just giving you guys ideas and challenging your biases. It says, "Yikes! The odds of $100 oil are rising." Like we didn't know that. It says oil supply shocks are threatening to propel prices to $100 a barrel as geopolitical tensions escalate, signaling pain at the pump that could imperil Joe Biden's reelection chances and complicate central banks' rate cut deliberations. Could be. It says the danger of these long cycles is that the belief lives on for much longer than the market allows. Many investors are therefore unprepared for this new environment. The environment he is describing, I took a look at this article. He's describing basically the 40-year downtrend in interest rates and how we've broken that downtrend in interest rates to the upside. And that's where I am going to make all my money is being early, changing my mindset before everyone else and buying the bottom of commodities when nobody was looking at it. And I got a lot of crap too, guys. I got a lot of crap for buying that. And everyone was telling me oil's not going to go to $200 a barrel. Even though I came out and said, oil's going to 250 plus by the end of the bull market. And here's the shortfall of most people. The shortfall is when you're in an environment where you're at a bottom, they can't envision a future being different than the bottom. They're basically stuck in a thought pattern where whatever previously occurred is going to occur into the future. And that is really dangerous in investing. You want to be looking at where everyone is piled on one side and take the opposite bet. And I think that has something to do with the way that people think. I think very different than the majority of people. Most everyone is like they just follow the rule books. They just follow what the instructions tell them. They just follow, and I don't do that. I'm always like testing the outer limits and the borders to see what the outer borders can support and hold, and what is the data telling me, and then follow the markets based off that data. So yeah, that's what he's talking about there. CRB index looking fantastic. Big move to the upside, something like that could occur. Very much so, and that's probably this here is probably about the same size as this. Maybe that is the case. Maybe that's where we go. Lynn Alden talking about fiscal dominance, and I talked about fiscal and monetary. Monetary is the bank lending in the system. Fiscal is the government spending. And what she's saying is that the fiscal side is more dominant. So it's AKA fiscal dominance. She says when you're pre-stimulate an economy with 1.6 trillion in deficits, the resulting economic slowdown can look a lot different than it otherwise would. So what she's saying is because of the fiscal side and because of these big deficits, just like I said before, it could look way different. A recession could look way different than before. And everyone else, I'll call them linear thinkers. The engineering types, myself, Lynn, I heard some other people talking. I don't think we're of the same cut. Other people just look and they say the biggest fall in full-time workers ever without a recession, the biggest rise in unemployed workers ever without a recession, the biggest increase in part-time workers relative to full-time, blah, 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 blah. We're going to get a recession. What if we already went through it? What if 2022, 2023 was a recession, or I should say 2022? What if that was the bottom and gold rocketed out of it? And maybe we don't fall. Maybe nominally we go up, even if we get a recession. And that is exactly what Lynn is talking about here. She's saying maybe this recession looks a lot different and the economic slowdown could look different. And people cannot wrap their head around that change. And that's where they're sunk in the past prior 40-year paradigm. They're not looking at the danger of these long cycles. They are still thinking many investors are therefore unprepared for this new environment. They're talking about the new environment that Lynn is talking about here, fiscal dominance and all this other stuff. They're not prepared. They're still thinking the old way of thinking down here. His forecast is 5 years from now, prices will be higher, says Dave Ramsey. It says it takes a lot of careful analysis to formulate such a nuanced and precise prediction. Not really. It's just based off of families forming and how underbuilt we are. Dave Ramsey predicts what's in store for the housing market again after saying he got it right 2 years ago. He is right, and he's going to be right again. We are too tight in the market. We don't have any homes. There's no inventory. It's like I don't. It is really hard. It'd be like going into a grocery store. There's nothing on the shelves, and then someone walking out saying that we're in this big bubble and that prices should go down because we have so much inventory. It's like you have nothing on the shelves here. It's gone. Christine says U.S. oil production is probably 1 million barrels per day less than what the market believes, and we have infrastructure limits to growing before Q3. Listen to my YouTube and to learn why. Yeah, she talked about this and I listened to it. And basically, natural gas, the way that they could increase oil production is they'd have to flare natural gas because the pipelines are getting full from natural gas. And some of the hubs are actually printing negative natural gas prices. So that could limit oil production in the United States, and she thinks it is, and we could probably be down 1 million barrels already from this basic infrastructure pipeline limits. Larry says, Drunken Miller on hedging. It says, I don't really like hedging. To me, if something needs to be hedged, you shouldn't have a position in it. And I totally agree with him. 100%. Why are you in something that you think is going to go down? Like, what? I mean, maybe for tax purposes, you don't want to sell it and you hedge it, but I understand his reasoning behind it. It says, where are we in the cycle of market emotions? I think that we are in euphoria for AI and tech. We could very well be transferring into complacency. We might get a big sell-off and then we go back up. I also think that we are in the hope phase up here for a lot of the commodity stocks. We can even look at the potential patterns here. This here is basically the beginning of stage two. So I think we are going into the beginning of stage two. Technical. This is a basing pattern for anger, depression, and disbelief. Disbelief is when you start going kind of well, we're into disbelief and hope for some of these commodity stocks. We're in euphoria and potentially even complacency, depending on what you're looking at in the overall stock market and tech. This goes down, the money will flow over to commodities, which will go into this phase over the next 5 years or so. Oil is set up to run to $400 over the next decade. I agree with that. This is your big breakout. So a lot of people, they'll look at this. This is your consolidation. This is more or less the real estate cycle, your monetary side driving this. And then you got the fiscal side pumping this to the upside. That's going to overpower any sort of slowdown on the monetary side. So this is your consolidation here that we're breaking. This was the last bull market peak, your consolidation, your breakout of the consolidation, your retest of the consolidation, and we're just breaking the downtrend line here to the upside. He has a projected move from bottom to top of 580% from bottom to top, which is the leg. This here is a flag pattern, and then you put the leg on top. He's got a $440 price projection on crude oil. Like I said, we're going over $200, $250 a barrel. His projection's 440. I could easily see that, yes. Now, everyone and their mom's going to be like, how can people afford oil? That's the wrong question. The other question is, how many people do we need to price out, and what price does that take in a very inflationary environment where they're printing money nonstop and during a war? How much barrels of oil do we need to basically kill in demand if we really get into a war that's in the Middle East? What if we need to really kill a lot of barrels of oil? That's going to take a very high price, and that is more than likely going to be a potential driver. It could be war. I've got on here, could crude oil outperform silver? And I've got crude oil versus silver, a breakout, a retest, and we're sitting on top of that breakout. Now, some people will say, no, silver's going to outperform. I don't know. I own both, so it doesn't matter to me. But I think crude oil could. It could. Not saying it will. No one likes natural gas. You can see that we are very low level. And it also, the fractal, you get a breakout from this falling wedge to the upside. It also fell back down early. We broke out of the falling trend line or falling wedge, and then we've come back and are doing a retest right now. And it may take some time for this to work its way back up against the Dow Jones Industrial Average. Gold versus the Consumer Price Index almost ready to break out. It was right there. Let me zoom in on this. I think I didn't add the other one. That almost looks like it's ready to break out. Here's gold breaking out against the Dow Jones Industrial Average. We are at a very big double bottom. I call that the booty bottom. And we are breaking out right now of that downtrend line. Perfect time to be buying for a long-term investment. Perfect. Now I said silver is going to run here while palladium lags, perhaps. Get into that palladium buy zone in the future. So maybe we could get into this palladium buy zone if silver runs here. And even though palladium may go sideways price-wise, silver could get a run here and we get a nice good dip in the ratio. Christine says, oil is going much higher. U.S. production is much lower than stated. Russia production impacted by sanctions and war. Saudi production at risk from warfare breaking out and the Persian Gulf. The second largest field in Mexico is on fire. Accordingly. But there's also another thing. Saudi Arabia has basically cut all their jackup rigs, a lot of their jackup rigs, because I think they know that a war is coming, and they're like basically getting everyone to safety. And this week, the gold to treasury ratio surged to levels reminiscent of the late 1980s. Investors are just beginning to recognize that gold prices can indeed appreciate while treasuries fall and interest rates rise. So this is the gold to treasuries ratio. He has a cup and handle. That's not really a cup and handle. Cup and handle patterns aren't bottoms. Basically, you've got a falling wedge here. that wedged up to a corner, it broke out. This could be a cup here, and then maybe it's a breakout into new highs. So I wouldn't call that a cup and handle necessarily. But that's where I'm going to end it, guys. It's pretty long. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested. We still have that coupon code LEAP going on if you'd like to use it. And that's all I've got for today. So we'll catch you next time. This is Finding Value.